But while we were under contract, there was a fire in one of the buildings. So one entire building, so 12 units were down out of 124 units, which added another complexity, right? So, not something you necessarily want on your first deal, but in hindsight, it was good. It gave us some experience. Like, still have the battle scars.
If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Drouin. Welcome, everyone. What is up? I am Matt Drouin, the host of the Go Big Live Real Estate Investors podcast. Today, I have a special guest, Mr. Percy Nikora. Percy is the investor relations and capital raising expert behind Penn Capital. Prior to his investment journey, Percy held executive level leadership roles in the financial services and pharma industries, including at Merrill Lynch, Dow Jones, and Pfizer. Before founding his own capital group, he was an avid investor in private equity deals, as well as commercial and residential real estate, giving him valuable insights into the needs of their investors. Percy has a keen understanding of what it takes to perform due diligence while effectively raising capital for new projects. You won't want to miss out on this exciting chance to get live access, question and answer with the man, Percy. Welcome to the show.
Thanks, Matt. Happy to be here.
All right, awesome. So I'd like to kick this off with the same question for all of our guests, and that is, you were born and now you're here. What happened in between?
In my case, a lot of stuff. That's a way of saying I'm getting old, right? But a number of things, as you sort of alluded to. I was in the tech space. I actually sold a tech company. I was on the entrepreneurial side with startups as well as Fortune 500 companies. And then, long story short, in the investing journey, as I was making all these different investments, I was realizing that real estate was giving the best risk-adjusted returns. So over time, more and more of my portfolio started to go into real estate. And now I'm pretty heavily weighted into real estate and went more from the LP investor side, more to the sponsor side, right? So we own and operate multifamily these days. Most of our portfolio is in the south and southeast of the country. We like the numbers we see there. We are exploring a couple other markets that fly below the radar, but that's generally where we like to invest, is markets that fly below the radar, have good job growth, good population growth, but have some room for rent increases, NOI increases.
Excellent. So where are you at nowadays in terms of your total holdings under management?
Yeah, so we actually have a pretty decent concentration in Huntsville, Alabama, which is a core of where we are located. We have about 22, 23 people down there because we are vertically integrated. We have our own property management function. So I think we've done about 1,200 units, 11 or 1,200 units in that area, 7 projects, 4 of them have gone full cycle, and we're continuing to be bullish in that market and, invest pretty regularly there. We're actually looking at a couple of deals in that market right now. Hopefully, fingers crossed, we'll have something under contract in the next week or so.
Excellent. Wishing good luck for you on that. So
thank you.
I don't usually ask this of our guests, but I figured to ask you because your background is in tech. In the corporate world, I guess, did you get into real estate by accident or was it something that you had like a premeditated thing, like that you've always wanted to do real estate? Tell me about that, because a lot of people like in tech kind of stay in the startup world and to never get out of it.
Yeah. So I guess depending on how far back you want me to go, I always knew that real estate would be part of my portfolio. And a lot of people are familiar with the book, Rich Dad, Poor Dad. I was lucky enough to have, I guess, what you would call the rich dad. And my dad had several businesses, took 2 companies public. So I would sort of observe what he would do as I was growing up. And even though his businesses were not necessarily directly affiliated with real estate, he would have part of his portfolio in real estate, fund a lot of the builders, et cetera. Mm-hmm. So, just sort of subliminally, I knew that, real estate would play some role in it. Initially, like I said, when I started out, real estate was maybe 5%, 10% of my portfolio. And then as you start investing, now, this could vary by person, but if you look at most family offices or most people who have quote unquote made it, whatever that means, you realize that a pretty large chunk of their portfolio is in real estate, and particularly into commercial real estate, right? So like many of us, when I first got into real estate, the natural thing that comes to mind is, oh, if you want to invest in real estate and you want to have rental properties, that automatically must mean single family, right? Because the misconception that I had was that large apartment complexes are owned by this, and there's no way we could, mere mortals like us cannot own that, right? But as you start researching it, when you try to grow a portfolio of single family houses, it becomes quite challenging to scale that. And so we started to look at other opportunities where we can still invest in that asset class, because we like real estate as a tangible asset. A lot of the benefits you get with it, the cash flow during the whole period, the, renters paying down the mortgage, the, tax benefits. So we liked that particular asset class, but wanted to scale it and looked at a lot of different things on the commercial side, including retail, hospitality, office, and landed on multifamily for a number of reasons. The main one being, unlike single family houses, as you probably know, are valued based on the comps or the surrounding properties in the area. Multifamily is really more of a business, right? So the valuation is based on the net operating income, sort of like your EBITDA if you're running a business. So every dollar you add to the net operating income, you're increasing the value of the property by almost 20x if you use a 5% cap rate, right? Because anything, the NOI or anything divided by 0.05 or 5% is 20x, right? So that's the name of the game, is essentially go in there, either identify a property that's underperforming, or you think you can drive up the NOI through a variety of ways. And we try to do that in a fashion where we're adding some value and services to our residents, but at the same time, it's driving up the net operating income and, giving a nice return to our investors, right? So I think that's the key. All these different pieces have to come together, but when they do, you can really significantly drive up the value of the asset.
Absolutely. So let's fast forward a little bit to your first big deal that was a stretch for you, where you had to raise capital and that type of aspect of commercial real estate. Tell us about that deal and kind of what was the seminal moment in terms of when you made that switch from smaller deals to larger ones.
Yeah. So initially when we started to invest in multifamily, we honestly were investing with just using our own sort of capital and investing with other sponsors. This is going back 2011, 12 in that timeframe. And for a couple of reasons. One, we wanted to get an introduction to the space, wanted to make sure we learned the ropes, so to speak. So we had made it very clear to them, saying, hey, look, we would like to invest, but we also want some visibility into the operations of the company. We want to see how things are going. And the sponsors at the time agreed. And, there were a couple investments that we made, with a handful of sponsors. And just over time, what we started to realize then as the markets were heating up is that the underwriting for the sponsors was also changing, and some of the assumptions were changing. We like to be pretty conservative with our investments. So we, around that same time, there were other people that came to us and said they'd like to invest with us, alongside us. And I also met my business partner who wanted to invest more into multifamily. So we said, all right, let's see if we can find some deals. Now, it sounds easier than it is, because the brokers obviously want to have a proven track record, right? So it's almost like a catch-22. So it took us a while. It took us almost a year and a half to identify a good deal that met our underwriting assumptions and criteria. Visited the properties, walked them, a couple of them that we had we're given an LOI for. We once we walked the property, we found all these deferred maintenance issues. So we had to, try to bring that to the attention of the seller. At the time, the market was so hot, they didn't want to negotiate. So they're like, take it, or, I'll go on to the next buyer. So we passed on a number of opportunities. So it took a good year and a half to get something under contract. And we finally did. It was actually a portfolio of two properties, but one of them, the one that we ended up closing on, was just around 9.25 or 9.5 million, in that range, which seems pretty small these days. But when it's your first asset that you're acquiring, going from single family houses to that, it seems like a lot, right? And at the time we had, I think the raise for that was just around 2.5 million, thereabouts. So obviously we invested our own capital, and by the way, we put in money in all our deals at the same level as the LPs, right? Because we think that's the right way to show alignment of interest. So we had put in our capital, but then we did a 506c raise, which means that we could advertise, but also approach people that we may not have had a prior relationship with. So although a lot of the investors we already knew, a fair amount of them were new, or we had not had this, that's a strong relationship prior to introducing the deal to them. So just to be on the safe side, we went the 506c route, which was a good thing. We also we experimented with running some ads on different social media platforms. This was 2018.
Yeah.
So that was fairly new at that time, right? So we were trying to see which platform gave us the best results. We had to tweak our marketing. Long story short, it turns out that even though, and prior to this, I was doing about 10, 15 years of angel investing, right? So I had all these investors around me. I thought, hey, it'll be no problem, to raise $2.5 million. But the reality is, even though people know you and have invested more money in other aspects, they know you in that particular niche, like tech companies or in startups. Now, when you go to real estate, they're like, oh, what's your track record in real estate, right? So you can show them all these other things you have done, but it's not multifamily. So you have to give people some time to sort of adjust their thinking, sort of shift the mindset from saying, okay, you've been investing in the startups, you're successful in that space, but now you also can translate that into this other area, another asset class. But people want to see some proof. So I think the first deal is going to be more challenging. So my advice to anybody raising capital is, if you think you can raise, $1 million, just cut it in half, and then plan contingencies on top of that. So ultimately we were able to close the deal. One of the interesting things about that deal, it was our first deal. We put it under contract. Like I said, raising capital is always a challenge. But while we were under contract, there was a fire in one of the buildings. So one entire building,
wow.
I think property had 11 buildings. So 12 units were down out of 124 units, which added another complexity, right? So, not something you necessarily want on your first deal, but in hindsight, it was good. It gave us some experience. I still have the battle scars. I guess I'm wearing this long sleeve shirt to hide. But the, it was a good learning exercise, but again, not something I would recommend going into if this was your first deal, because you think you could, there was obviously insurance on the property, and you would think you could assign, the seller could assign the insurance contract to the buyer. Not how it works. Insurance company is going to do everything in their power not to pay on that claim. The buyer, we're trying to get the ultimate funds to rebuild what was lost. And the seller, once they're done with the transaction, they're looking to wash their hands of it. So you have all these different dynamics at play, lawyers from different parties. You have to structure a whole. So ultimately we created a escrow account where we had to put up some money. The seller had to put up some money that was used for essentially rebuilding that entire building that was lost. And that as our contractor was doing the construction, there were draws that were paid out, and then the seller got the insurance money. And, you don't have really visibility to that side of the transaction, but they were, according to the agreement we had with them, they would then reimburse us for the expenses that were incurred in building that property back up. So again, a little more complexity than you want on your first deal, but now that we went through it, we're okay, not okay, but we're a little more accustomed to it. In fact, there was another deal we were looking at, and something like that happened where there was an insurance claim, and the seller was freaking out about it. We said, that's okay. We have experience with this, we're okay as it is.
Yeah, no, that's how the universe works, right? So, it tested you with this one experience with this fire. I thank God that's never something that's happened to me in the past, but there's always in the PSA, the purchase and sale agreement, there's always references to insurance monies in the event that there is a loss, and kind of how that plays out and that type of thing. So I'm just a little bit curious. I want to keep pulling on this thread, because this isn't a topic that we've really explored in the podcast, is How was your bank okay with essentially closing on this thing, funding the loan with having essentially 10% of the units erased from this? I mean, typically with Fannie Freddie debt, they won't financing that's anything less than 90% occupied, and now you have a handful of down units. So tell us about that, how that
Yeah.
worked.
So at that time, that was a bridge lender. But even so, we had to put up pretty much the whole construction amount. We had to raise that capital and put it into escrow. And then they would reimburse us as we were going through it. So the bank would only give X amount of proceeds, right? So pretty much, I have to go back and refresh my memory on the exact numbers, but about 650,000 or thereabouts was we had to raise and put into escrow because again, the bank wasn't going to necessarily, change their proceeds. And then we got that reimbursed from the seller, but they were almost like two different transactions that had to get coordinated. And then, again, like I said, you have all these different players and different stakeholders and the GC in there, and the GC is doing draws. So like, again, more than you want to take on for your first project. But once you go through it, you're like, okay, it's not that bad. At the end of the day, the main thing is nobody was hurt with that fire. It was a tenant who had lit a candle and went to take a bath, and a curtain caught on fire. And
Wow.
it took the building down, if you can believe it or not. So the main thing, everybody was safe. Nobody was hurt. Yes, there was some displaced tenants. So we tried to find an existing vacancies or whatever, where they can be housed. But then it took a good 6 to 9 months to rebuild that, that property. Right. So obviously you have permitting issues and you run into permit delays and all of that type of stuff. But once you get the COs, you pretty much have a brand new building and new units, et cetera. So from that standpoint, it's not a bad experience, and you can then hopefully it's relatively new. It has new fixtures in it. Everything's new, so you can maybe rent that as an upgraded unit, right? So you get a slight rent bump as well for those types of units. It's just a lot of headache, and as we were saying before the show, I had a full head of hair when I started this process.
So on the subject of the actual communication with your investors, so this happened when you were mid-contract. Did you already have at least all of the commitments from your investors in this deal at that point in time? How did you communicate this issue with them? And then also, how did it change the amount that you had to raise? Did you ever raise additional capital beyond the $2.5 million you had to raise to do this, or how did that play out?
Yeah, good question. So I think this happened, I'd say about 60% into the raising process, right? So we were under contract, we had started the raise, all the docs were there, and then this event occurred. So we obviously, actually, I still remember the call. I got a call, and I forget whether it was the regional property manager or my partner calling, and they're like, "Oh, we have a fire," and I thought they meant, oh, okay, it's one of those business, fire as in urgent issues we got to put out. It's like, no, we really had a fire, and there's fire trucks on there. And, within a couple hours, there were like these news articles, or it was on the news and in that area where, obviously fire trucks were there and all that. So I'm like, okay, I'm flying down tomorrow. So we flew down there to survey what happened, walked it with our general contractor, who was going to be doing some other stuff at the property, but their scope of work obviously just increased. Luckily, they had some experience working with these types of things. We obviously had to start researching what that meant, whether we should engage a public adjuster or not, right? So we got exposure to this whole side of the industry that we didn't really have prior experience with, right? But like I said, quick learnings, and then ultimately, we had to negotiate a lot with the seller. Ultimately, came to an agreement with the seller on putting some money into escrow. In terms of raising more money, I don't, if there was, it wasn't much, but ultimately what we had to do though is reforecast our underwriting, et cetera, because for a period of time, you don't have those 12 units, right? And that's like 10% of the property. So we had to redo all the underwriting, share that with the lender, share that with our investors. There was most of these insurance policies rather have a loss of business clause in them. So that's the other part we had to negotiate. It's not just the construction costs, but it's also this business, so loss of rents. So that was for a particular amount of time. What ended up happening is the I think we had negotiated that with the seller as well, saying, okay, you'll owe us, let's say, to make up like a 3 months worth of rent, because our original projection was that's how long it would take for the building to be ready and COs to be ready. But then it turned out that with the delays, it was more like whatever, it was 4 or 5 months for the construction. So, we tried to go back and renegotiate with him on that. So a lot of moving parts, but ultimately that's a good question. And I really am grateful to our investors, our early investors. And through the years, we've had a very loyal group of investors, and we try to be loyal to them. We want to make sure we take care of our investors. So obviously we want to give them the best returns possible. Our deals the waterfall is slated so that I think it's pretty favorable to our investors. But at the same time, any new deal that we take on these days where our ability to raise capital has increased, I think we've raised like 65 so million. What we can do is we first offer it to our existing investors before we open it up to everyone. And we say, would you like to participate in this opportunity? So they have the right of first refusal on all the deals we do. And that's just part of being loyal to our investors who were loyal to us when we first started, right? Because we wouldn't be where we are without their help. So, we always do that. We always try to communicate good and bad news. In fact, if there's bad news, we try to communicate that even faster than good news. Not saying it's perfect. We actually need to do a better job there. And we've just reinstituted our quarterly webinars. So we previously used to put out reports to our investors, either on a monthly basis or quarterly basis based on the project and where it is in its life cycle. But now we also started webinars. So we have webinars on a regular basis that they can either attend live and ask any questions they have, or, we share the recording with them. So there's always more stuff you can do, I guess, in that area, and we plan to do so. But our goal is to be loyal to the investors who've supported us through the years. But that's a good question. If you ask me, would you have invested in a project that, in the middle of the deal, it had a fire? I'm not sure. It would really depend on the sponsors and my confidence in those sponsors. So, I guess our investors had some confidence in us, and that deal, by the way, has we sold that in just under 3 years. Our projected hold time was 5 years. And when we sold it, we set a record in that market for the sales price. And we sold it in end of 2001 when the prices were going up. So, they did okay. We got what the projections were. So hopefully, all of this extra effort was worth it.
Yeah, no, 100%. No, that's a great ethos to have with your investment partners too. I mean, we do the same thing whenever we're doing a raise. We always give first shot with people that have partnered with us in the past. And the thing is that, a lot of people getting started in this and they're scared of capital raising, and they're like, oh my God, am I going to have like 100, 200 investors or so that I have to report to and that sort of thing to do my first couple of deals? No, I mean, we've never really partnered with more than 5 different investors, because we keep going back to the well and we perform for them. We communicate with them regularly and we have a good relationship. So we've never really had to branch outside of there. I mean, we have a distribution list of like 2,000 different people that are on our subscription list, but we haven't really had to go outside of that sphere. If you do good, you will do well in the process. So that is awesome. Let's talk about the raise a little bit while we're wrapping up the recorded part of the show. We went back to that well of the angel investors and that sort of thing. And, you're figuring out that this is a lot harder than I thought it was going to be. So what's your advice for people that are out there that, maybe own a couple of properties and they're looking to scale into larger deals and have never raised capital before? What's your suggestion or recommendations on how they should get started and at least getting themselves positioned as raising capital in the future?
So most deals in our world are done through syndications, right? Although we now have a fund. If you're just starting out, I would suggest going the syndication route. My suggestion is, and there's some controversy on this, but my suggestion is do a 506C offering where you can advertise, even if you know the folks. You are limited to accredited investors when you go down that route, but just create a list of everybody you know. In our case, they were all accredited anyway, so it wasn't that really didn't factor in as much. there is an extra step you have to go through where you have to validate that they're accredited, or a third party has to validate, but it's really not as that complex. There's some software that can help streamline the process. But the biggest piece of advice I can give you is when you're doing the syndication, really, you have maybe 2 months, if you're lucky, 3 months based on how you structure your contract to raise the capital and close on the deal. And that is going to go in a blink of an eye. So it may seem like a long amount, a lot of time, but by the time you start putting the deal together, you do your due diligence, you do the marketing for the deal, the legal documents for the deal, you're almost going to be at mark 60, when you start it. So you don't have a lot of time to close on this. So don't start the conversation once you have a deal. You should really be starting the conversation with your investor or potential investors way before that. So lay the groundwork, let them know these are the types of things you're working with. You can give them a sample deal. It doesn't have to be the exact deal you're going in, but you can say, look, I'm looking to purchase these types of properties, and here's the high level, projection that we're targeting, right? It's a pro forma anyway, but you can give them those sort of high level sort of guidance. And you can tell them, I don't have a deal right now, but there are a couple of things we are pursuing. And when I do have something, is this of interest? Should I put you on that list to circle back with? So start that process. And like I said, if you can get soft commitments from people saying, assuming I find something like this, how much are you likely to invest? Are you okay with investing for the 3-year, 5-year, or however long you're planning to hold the property? Try to lay all of that groundwork way ahead of time. And then when you actually have the deal, then you can go back to them and say, okay, now I do have a deal. Here are the specifics for the deal. You get the documentation, let them review it, the PPM, all of that, get them to sign up. The other piece of advice I'll share is, even though people sign the docs, or it'll take much longer to sign the docs, you might think, oh, it's a few day exercise. No, it takes about 2 or 3 weeks just to, I call it to herd the cats. That's, that's the phase where you have to make sure everybody signs the documents. Once they sign the document, they may not immediately wire the funds to you. They may be traveling. So there's all sorts of things that you have to do to make sure that the funds are in on time for closing. And in fact, that reminds me, on that deal I was mentioning, I think even at the last, there were a couple of things that in your first deal you may not think are needed. Like even in the lender's underwriting, they may say, oh, this is the insurance that's needed. And they may have laid it out on a quarterly basis. So from a cash flow standpoint, you're thinking you're going to pay that on a quarterly basis. When it comes time to actually close, the insurance company wants all of that paid up front. But the lender might want reserve. So that could be an additional couple $100,000 that you have to, make sure is raised and you're ready. And then we had a couple of folks who had signed the documents, had committed, we had spoken to them. But there was just a delay in wiring the money. So at the last minute, we had to scramble for $200,000 to make sure, otherwise you're out of the contract, or obviously the seller will try to say, oh no, give me another $25,000 if you want to move the closing date by a day or 2 days, things of that nature. So just make sure you have double the amount of soft commits than you actually need. Start the conversation way early. And then as you get closer towards that target closing date, make sure all the pieces can come together and that you're set for closing. And if it's a good deal and you have challenges, reach out to us. We're now in a position where we can actually come in as co-sponsors and maybe help with some gap funding, et cetera.
100%. Those are amazing words of advice, Percy. And thank you so much for getting on the show. We have our live studio audience waiting backstage that are excited to ask some questions of you. So if you're listening to this right now on the recorded version on Apple Podcasts, Spotify, wherever you get your podcasts, make sure to join the Facebook group, the Go Big Live Real Estate Investors group, and you can get exclusive live Q&A with our esteemed guests like Percy Nikora, like Reed Goosens, Matt Faircloth, Brian Burke, Stephen Libman, really amazing guests that are absolute titans and beasts in the commercial real estate space. So be sure to do that. And Percy, thanks for coming on the show.
Thank you, man.